Should you buy a house in the 2024 housing market or should you wait? That's exactly what we're going to talk about in today's video. We're going to take a little bit different approach though, and we're going to talk about the macro view versus the micro view when it comes to buying a house. Now, the question of should I buy now or should I wait comes up quite often on my video, so I want to spend some time and talk about it. But typically, when someone is asking that question about buying now versus waiting, the primary reason they're asking that question is because they believe that something is going to change in that environment that's either going to limit their ability to purchase or might help them in some way. So what I want to do today is start with the macro view of this question of buying now versus waiting and the things that we need to think about in that macro view. Now, when I'm thinking macro, I'm talking about the economy. I'm also talking about the possibility of a recession, a change in mortgage rates, house prices, supply and demand. Really what it comes down to is talking about things that are really out of your control and how that might affect your ability to purchase a home. So when it comes to the macro view and the economy, we know at the moment that the economy is slowing. With CPI recently coming in better than expected, GDP forecast starting to get cut for the fourth quarter, along with the slowing on the employment front, which has actually led the Fed to pause for 2 consecutive meetings, leading the market to believe that the Fed hikes are likely over. So what typically happens in a slowing economy? Well, as we've discussed it in other videos, as the economy slows, more bad news starts to come out in the media. And bad news typically means lower interest rates, which we're actually going to talk about more here in just a minute. Now, if the economy slows enough, then the next thing that might be happening is a recession, which has typically been defined as 2 consecutive quarters with negative growth. And while that definition changed a little bit last year, we do know that the economy is continuing to slow. But the real question at the moment is, are we actually headed for a recession? And if we head into a recession, how might that affect you as a potential buyer out there in the market? Well, the things you have to consider from a recession standpoint are, do you have financial stability? Do you have job security? And if I'm being honest, these things are very, very difficult to predict. Now, what I will say is that typically in recessions, the people at the lower end of the pay scale are the people that get affected the most. But that's not always the case. You can also have layoffs at Fortune 500 and Fortune 100 companies as well. But with that, these people are typically in a position to go out and get another job. Now, that doesn't necessarily mean they're going to be making the same exact salary as they did before, but we do know at the moment there's over 9 million jobs available, which means the likelihood of getting another job is really, really high. But as the economy slows, that number is likely to dwindle, and that's something you have to factor into your decision. Now, a moment ago, I mentioned slower growth in the economy typically comes with bad news for the economy, which in turn typically leads to lower mortgage rates. So how does lower mortgage rates affect the housing market, and how should that factor into whether you should buy now or wait? Well, like I always say, when it comes to picking a top or a bottom in home prices, it's very, very difficult. In fact, it's a fool's game. Well, it's very, very similar in trying to pick the top or the bottom in mortgage rates, because there's so many different factors that go into mortgage rates. But with that, you're likely to see mortgage rates continue to trend lower as the economy slows. And with that, every 1% change in mortgage rates, whether it's 1% higher or 1% lower, either allows 5 million more people to be able to qualify to buy a home or eliminates them from buying a home. So as mortgage rates rise, that typically means less buyers out there, less buyer demand, less competition in the housing market, which typically means less home sales, and oftentimes sellers having to reduce their prices in order to get their homes sold. But that all comes down to inventory, which we'll talk about here in just a moment. But on the flip side, as mortgage rates come down, that typically means more buyer demand, more competition out there in the market, which is similar to what we saw over the last couple of years. But as I always say, it always comes back to supply and demand. And at the moment, inventory is still sitting near historic lows, which is one of the main reasons that you've seen price stability out there in the market. So even though inventory is low and demand is low, we haven't really seen any major drops in home prices because the two have essentially been moving in lockstep. So as demand comes down, inventory has come down as well, even at a time when we've seen mortgage rates climb. So last year in 2022, we saw mortgage rates climb to 7% and we saw buyer demand drop. And at the same time, we saw the number of sellers having to reduce their price rise to 43%. Well, this year in 2023, what we've seen is interest rates actually move even higher, touching 8%. which is the highest level that we've seen in 23 years. But during that same time, we've actually had less sellers reducing their price, along with home prices stabilizing because demand and inventory are more or less moving in unison. So when we talk about the macro view of the economy, things like mortgage rates and house prices, and the idea of house prices dropping or crashing and or mortgage rates going up even higher, I want to ask you the question of what has to be true in order for that to happen. And before we dive into that question, I'd like to take a minute and ask a favor. If you find any value in my videos at all, do me a favor and hit that thumbs up. Also, subscribe to the channel to stay updated on everything real estate related. So for all of those people out there thinking that mortgage interest rates are going to go even higher and house prices are going to crash, I want to ask you that question. What has to be true in order for that to happen? Well, in order for interest rates to continue to move higher, you need a super strong economy. You need employment to stay strong. You also need inflation to actually stay high to some degree, because that means consumers out there are spending more money on goods and essentially driving up the prices of those goods. And if that were to happen, what the Fed would do is continue to raise the Fed funds rate, which in turn would create additional volatility in the market, probably create a larger spread between the 10-year and the 30-year, and drive mortgage rates even higher. But we know from the reports and the stuff that I mentioned earlier that CPI is actually coming down, that employment is actually getting worse, and that's exactly why the Fed is paused versus continuing to hike rates. So if you're someone that likes to pay attention to the data because the data never lies, well, the data at the moment is supporting lower rates. Now, on the flip side, let's talk about home prices. What has to be true in order for home prices to crash? Well, it comes back to supply and demand. It always comes back to supply and demand. You need an imbalance. You need way more supply than you have buyer demand. And at the moment, as we talked earlier, those two are moving in unison. But that's not likely to stay the same forever. We're in a slower time of the year, which seasonality plays a part in that. So this is a slower time of the year for inventory to come to the market. So let's talk about spring of 2024. We're likely to see more new listings come to the market. And depending on what happens with mortgage rates, we may or may not see demand pick up. But if I had to guess, I would think mortgage rates are going to continue to grind lower, no big moves, but rates are going to come a little bit lower, which is going to add buyer demand to the market. Now with that, inventory is going to increase, but I'm asking, where is that inventory going to come from? Is it going to come from sellers looking to sell their property and go rent something? Is it going to come from sellers looking to sell their property and move back in with their parents? Is it going to come from sellers looking to sell their properties and become homeless? And the easy answer is no. It's going to come from sellers putting their homes on the market and taking another home off the market, which means you add one home to the market, you take one off, so there's no net gain in inventory, which means inventory levels aren't really increasing. Now, I realize that's not going to be the same for all markets out there. Real estate is local, so some markets are going to see more of an increase in inventory versus other markets. In fact, those markets that appreciated the most over the last couple of years, those markets are likely to see more sellers looking to take advantage of selling in those markets, in addition to many of those sellers out there having to do larger price cuts if more inventory is on the market. But when we look at a nationwide basis, that doesn't really solve the problem. Now, with that, new construction is going to help out, right? A portion of that inventory that we need is going to come from builders building homes. But as we know, that's also spread across the nation. So depending on your market, it may or may not help. So the only real way to see a big drop in home prices is to see a lot of new listings come to the market with very little buyer demand. So if you're one of those people wondering when that's going to happen and what to wait for, I would tell you to pay attention to the new listings chart, because this chart is going to be the first indicator to show you that we're seeing an increase in new inventory. In fact, you're going to need to see it consistently over an extended period of time to really add enough inventory to the market to see a sizable drop in prices. And for all of those people out there believing that we're going to see foreclosures and that's going to be the driver that's going to drive supply, or it's going to come from the Airbnb bust, the reality is it's not supported in the data. In fact, distressed sales are still sitting near all-time lows. Now, I realize that could change if we head into recession and people lose their jobs. Some of those people are going to need to sell their homes. But at the same time, those people typically aren't concentrated to one market and all listing their home at the same time. In fact, many of those sellers have equity in their home, which means they can sell their home at a premium compared to what they owe, which means it's not really a distressed sell in that situation. It's a seller being able to sell their home at market value. So if I were a buyer out there contemplating whether I should buy now or should I wait, thinking that the economy is going to change, house prices are going to change, mortgage rates, all of these things are going to change to make it way more affordable for me to buy a house, I would ask you to stop and consider all of the things that we just talked about. Yes, mortgage rates are likely to come down. That will improve affordability, but you're not likely to see a drop in mortgage rates from 7% down to 4% or 3.5%. What you're more likely to see is interest rates go from 7%, probably somewhere into the mid 5% range, but that could take a year. It could take a year and a half before that actually happens. And with that, home prices aren't likely to move much during that period of time, which means you're not likely to get that home for any less if you wait a year and a half to buy that home. And during that period of time, you could have been paying down the principal balance on that loan, essentially putting money into a forced savings account. And then if rates move lower and you still have job security, you still have all of the things you had when you originally applied for that mortgage, you can refinance and take advantage of that lower rate. And the reality is, if rates continue to move higher, you've actually secured a lower interest rate now, which typically means a lower mortgage payment. And if rates move down, you can just take advantage of it at that time. Again, assuming you still have the same job, your credit's still good, nothing's changed on that front. So that's my thoughts when it comes to the macro view. But I want to ask you, what are your thoughts on what I just said? Do you agree with my thoughts there, or do you believe something different is going to happen? Do me a favor and let me know in the comments below. So now that we've talked a little bit about the macro view, I want to talk about the micro view. The micro view are really things that you have more control over. The macro view, you essentially don't have control of those things. You can't control the economy. You can't control whether we head into a recession. You can't control rates or prices. But on the macro view, you can control things like your time horizon. And this is probably one of the most important things I want you to consider if you're thinking about buying a house. How long do you plan on being in that property? And the reason I ask this question is because you need a longer term time horizon. You need to be thinking from the point of 5, 7, 10 years that you're going to be in that home versus the buyer that thinks, hey, this is my starter home. I'm just going to buy it, live in it 1 or 2 years, and then I'm going to make some equity and I'm going to turn that into my next home. While that could very well happen, it's not really likely based on what's happened over the last couple of years. Because we've seen so much appreciation in such a short period of time, it's more realistic that we see home prices move sideways more so than anything else so that we can catch up to that longer term trend. So that's why it's imperative that you have that longer term time horizon, not because prices are going to crash, but more so that you're not underwater when it goes to sell that home, because selling costs to sell a property are going to range somewhere between 5, 7, 8% depending on your location. If you have a shorter term time horizon, there's a chance that you could end up owing more on that home than it's actually worth when it comes to selling it. And when talking about that longer term time horizon, I also want you to consider where you are in your job, where you are in your relationship. If you're someone that's new to the workforce and you're just starting in the corporate ladder and you know you're going to be moving up and there's a chance that you get relocated, you need to factor that into your decision. At the same time, if you're someone that's single and you're planning on getting married, you're planning on having kids, that's also something you need to factor in your decision. If you're considering buying a loft or a 1-bedroom home, but you know you're engaged, you're going to get married, you're planning on having multiple kids, then you need to consider the right property, because if you buy too small of a property, you might have to end up selling before that time horizon you actually had in your mind. So you need to factor that into the decision-making process up front. In addition to that, you need to have financial stability. You need to have money in the bank on top of your down payment. And you also need to be comfortable with the payment. You can't go into the process thinking, I'm going to be able to refinance in 2 years. This payment sucks, I can barely afford it, I'm going to do it now and then I'm going to refinance and things are going to get better. No, that's the wrong way to think about it. You need to be comfortable now. You might not like it, but be comfortable. And then if rates do come down, you can take advantage of it at that time and be in a better financial position. But you can't put yourself in a position where you can't afford it without refinancing, because if rates don't move lower for an extended period of time, you could be setting yourself up for failure. So when it comes to buying a house versus waiting, what I would ask you to consider is just focus on the things that you can control. You can control your down payment, you can control your budget, you can control what you're comfortable with, you can control your credit score. These are all things that you can work on while you're waiting. There's nothing wrong with renting. In fact, renting is buying you patience until you're ready to purchase a home. But what I will say is the earlier in your life you can stabilize your housing costs, because there's no such thing as a 30-year fixed rent, the more likely you are to build equity and put yourself in a better financial position long term.